In the world of money, power is rarely loud. It whispers through interest rates, it hides inside market signals, and it reshapes nations without a single vote cast. In the late 20th century, one man quietly became the most powerful economic figure on earth, Alan Greenspan. But to understand how he transformed American money, we must begin long before the 1990s, back in the chaotic money world of the 1970s. In August 1971, President Richard Nixon ended the convertibility of the US dollar to gold. America had just severed the last link between its money and the world's oldest currency, gold. The global financial system entered a new, uncertain age. Without gold anchoring money, inflation hit like a hurricane. Oil shocks, wage price spirals, political instability. Americans watched prices rise faster than their paychecks. Then came Paul Volcker, the giant who decided inflation must die at any cost. He pushed interest rates above 20%. Painful, brutal, historic. But Volcker's war brought inflation to its knees. The 1980s created a new battlefield. Markets were faster, global, unpredictable. America needed a different kind of Federal Reserve chairman. Not a warrior like Volcker, but a strategist. A man who could read the economy like a coded message. Alan Greenspan, a soft-spoken economist influenced by Ayn Rand and free market philosophy, was appointed by President Ronald Reagan in 1987. Few knew him, but those who did said he had a genius for interpreting economic signals. Just 2 months after taking office, disaster struck. The stock market fell 22% in a single day. Black Monday. But Greenspan's calm statement, "The Federal Reserve stands ready to supply liquidity," saved the system. It was the beginning of a new era. Greenspan believed markets were smarter than governments. His job was not to control markets, but to guide them with subtle signals. A raised eyebrow, a single word, a slight change in tone. This became known as the Greenspan effect. The U.S. entered the 1990s with recession. But Greenspan carefully opened the gates of credit, lower rates. Stable inflation. Just enough fuel, but not too much. Businesses rebounded. Productivity rose. As the internet emerged, Greenspan kept money flowing smoothly. Too little liquidity would kill innovation. Too much risk would cause bubbles. But in the 1990s, America rode the sweet spot. Low inflation, steady growth, rising tech markets. Economists called it the Goldilocks economy. Not too hot, not too cold. Productivity soared, wages grew, millions entered the stock market. And the world believed America had found a new formula. Markets guided by the Federal Reserve's invisible hand. His speeches became legendary. Traders studied every phrase. If Greenspan paused for half a second, markets moved. If he smiled, investors cheered. Never had a central banker wielded such psychological power. Asia fell into crisis, currencies collapsed, but America stood firm. Greenspan's steady policy protected U.S. markets. Confidence in the greenback grew stronger. When a giant hedge fund, long-term capital management, nearly destroyed the financial system, Greenspan coordinated a private bailout. Quiet, strategic, invisible. Once again, he saved the markets. The same easy credit that fueled innovation also inflated a bubble. Startups without profits were valued in the billions. Americans became day traders. Money flowed faster than understanding. Cracks in the system. Though Greenspan warned of irrational exuberance, the bubble grew. When it burst in 2000, trillions evaporated. Some blamed Greenspan, others praised him for not stopping innovation. Legacy of the 1990s. The 1990s reshaped global finance. Central banks became economic commanders. Markets followed the Federal Reserve's signals. and the idea of a free market quietly changed forever. As Greenspan's credibility grew, financial markets took bolder risks. Wall Street mathematicians, armed with algorithms and new derivatives, started building a different kind of money machine. Mortgages were bundled, sliced, sold, then resold again. Risk no longer lived in one place. It floated quiet, invisible everywhere. Camera slow zoom over early financial modeling charts. Greenspan believed these innovations made the system safer. He assumed markets, in their wisdom, would self-correct. But beneath the surface, the foundations of credit were growing more fragile. As America prospered in the 1990s, the rest of the world began borrowing in dollars. Nations held U.S. Treasury bonds as if they were gold. The dollar became the beating heart of global finance. And Greenspan, unintentionally, became the world's unofficial economic captain. But when one currency rules the world, its decisions become global destiny. Many economists assumed America had entered a new technological age. Productivity numbers looked miraculous, but not everyone agreed. Some argued the new economy was an illusion, driven by cheap credit, not technological transformation. Others said Greenspan kept interest rates too low for too long, allowing speculation to grow unchecked. The success of the 1990s didn't disappear, it evolved. Low interest rates continued, borrowing became easier. Homebuyers stretched their budgets, banks invented new mortgage products. And for many Americans, wealth seemed as simple as signing a loan. In the shadows of Greenspan's revolution, a new bubble quietly formed, the housing bubble. Greenspan eventually issued quiet warnings. He feared household debt, excessive leverage, and a credit system built on faith instead of fundamentals. But the machine he helped build was already running at full speed. Alan Greenspan reshaped not just an economy, but a philosophy. He believed in free markets, yet oversaw the most influential central bank in history. He fought inflation, yet his policies created extraordinary speculation. He calmed crises, yet his long shadow helped form the next one. As the 1990s progressed, wealth in America began to change shape. No longer built from savings or wages alone, wealth flowed from rising assets, homes, stocks, and retirement accounts. A new belief emerged. Economic security came not from hard work, but from ever-rising markets. Archival shots of families checking 401k balances. But rising markets also meant rising dependence on the Federal Reserve. With every crisis, 1987, Mexico 1994, Asia 1997, LTCM 1998, Greenspan acted swiftly, lowering interest rates, stabilizing markets. Investors began to assume the Fed would always protect them. This assumption became known as the Greenspan put, the belief that the Federal Reserve would never allow markets to fall too far. It was never official policy, but it shaped behavior like a law of nature. Politicians came and went, Reagan, Bush, Clinton, but one man stayed, Greenspan. His voice outlasted election cycles. His decisions shaped the political agenda more than any speech from the White House. Footage of Russian, Asian, and European finance ministers. Global leaders sought his advice. His cautious optimism was interpreted as prophecy. His warnings felt like thunder. The world had never seen a central banker hold this much influence. The 1990s created a culture of market worship. Stock tickers appeared on television 24 hours a day. Every American became an investor. Corporations reshaped themselves for quarterly earnings reports rather than long-term strategy. In this new era, markets didn't follow the economy. The economy followed the markets. And at the center of this transformation stood the Federal Reserve. Yet Greenspan himself rejected the idea of power. He spoke in riddles, resisted clarity, and preferred ambiguity. He once joked that if someone understood him, he must have misspoken. But behind the mystique was a simple truth. When the world trusted Greenspan, markets grew bold. When markets grew bold, risks multiplied. And when risks multiplied, the Fed's influence deepened even further. In these final years before the new millennium, Alan Greenspan's revolution shaped a world that believed in endless growth, endless liquidity, and endless stability. A beautiful vision, resting on a foundation far more fragile than anyone dared to admit.